Okay, good evening. Today I will be sharing with you the steps that you will need to take to start passively investing in real estate. And that's what we will be talking about this evening or afternoon, I guess, if you're on the West Coast. But right now it's about 7:30 and I'm getting kind of hungry. So maybe we'll keep this one to 15 minutes and then I can go get some food because I am starving right now. So if you hear my tummy grumble or rumble, that's what it is. So if you have any questions about real estate investing, or after this you decide that passively investing in real estate sounds pretty good, just go on over to callseth.com and we can set up a quick 20 or 30-minute chat and talk about your real estate investing goals, dreams, aspirations, all that good stuff. So passive real estate investing. So I've broken this down into more than a couple steps that you will need to take to figure out how you can start passively investing in real estate. So step number one is figure out if you want to be passive or active. Now that might seem self-explanatory, but I think that's really important because I've found that some people, when they start getting into real estate investing, they think they know what they want to do, and then halfway through they decide that it's not for them, and then it's too late to switch things up in that specific deal. So what are the differences between active and passive investing? Well, so why would you want to be active? Well, let's say you're like me and you have 11 years of real estate experience. So you're very experienced in real estate. That would be a check mark for active. Maybe you have the network and the connections to succeed in real estate, so that would be another check mark. Maybe this is your passion and you are fully committed to doing this every single day at all hours. You dream about real estate, you read about real estate. You don't watch real estate TV shows because those will drive you nuts because it's all entertainment based. So let's just focus on reading and dreaming and thinking about real estate, but not the TV, because that is one of my biggest pet peeves. So another check mark right there. So basically what I'm getting at is if you're looking to be an active person in real estate investing, this is really a full-time job. You need the connections, you need the team, you need the clout, and you need the track record and the experience to go behind you, or else you will make many mistakes and learn the hard way, which I do not suggest doing, but we've all been there at some point. Now, on the passive side, maybe you are a successful professional. You are excelling in your career right now. You're making really good money. You have a nice lifestyle. You can go on trips. You provide for your family. You may have some underperforming investments that you want to get out of into real estate. So somebody who's looking on the passive side, they're already busy doing what they do best, and they don't want to quit their job. And I don't want you to quit your job. As amazing as real estate is, I don't want anybody to quit their job because you're going to be starting at the bottom of the ladder again, because you have to learn everything. It's like learning a whole new language, learning a whole new career. You won't have any experience, you won't have any connections, you won't have any track record. So keep doing what you're doing and keep being successful at it. But just use that income that you're bringing in and then put that into real estate in a passive role. So, you might be a lawyer, you might be a doctor, business owner, you might be working in tech, all sorts of different professions. But if you are excelling, but you recognize the opportunities real estate provides and you want the benefits that real estate gives to you, then you may want to consider being on the passive side of the investment equation. So after you figure out if you want to be passive or active, and give this some thought, because like I said, some people start off in a passive role and then they decide halfway through the deal they'd rather be on the active side, and it doesn't really work that way. So you got to figure things out. Or maybe start off doing a small deal on the active side if you really think that's what you want to do, and you can learn, and if it works for you, that's great. But like I said, many of the passive investors that are succeeding in real estate, they're killing it right now. They are absolutely crushing it in their full-time jobs, in their careers, and they're taking full advantage of all the great things real estate has to offer. So, and if you want to talk about all the great benefits like tax benefits, capital preservation, appreciation, cost segregation, depreciation. I'm not sure if I said depreciation twice. Maybe I said appreciation. We get both appreciations. We get depreciation and appreciation in real estate. Just hop on just hop on over to callseth.com. We'll have a quick chat. So then you have to figure out what types of assets you want to invest in. There's a whole bunch. There's multifamily, there's industrial, there's office, retail, mobile home parks, you name it, it's all out there. And you know, some passive investors will have a potpourri of different investments in many different asset classes, and others like to focus on just one asset class. For myself, I like to focus on multifamily. CBRE, the big commercial real estate firm, just did a study earlier this year, and they looked at the past 2 recessions and how all these different types of real estate performed in these in those recessionary times. And what they found was the multifamily assets, so think apartment buildings, they had a shorter downturn, so things were sliding for less time. They were more stable in both recessions, and then they picked up on the upswing. So when the market kicked up again, multifamily was leading the charge. So investors in a multifamily deal were able to take advantage of a longer upswing in the market, whereas some of these other asset classes were still in a downward or neutral trend. So lots of great things. And by the way, like if you want to talk real estate, I'm always happy to speak with you at callseth.com and just have a quick Zoom call so we can chat face to face, thanks to the power of the internet. So you want to learn about all these different asset classes. Now, you don't have to become an expert, but you want to know the difference between a multifamily property and an office property, or a retail, or a mobile home park. You know, drive around, read some studies. All these big commercial real estate brokerages, and there's lots of firms that do these studies. Pick one up and read it. And if it bores you, read it before bed, and then you can fall asleep. And then maybe you can dream about real estate, and that's getting you over to the passive side. So you want to learn about the asset after you decide if you want to be passive or active. And then you want to learn about the different investment structures. So how can you as a passive investor invest in these types of real estate asset classes? Well, one of the best ways is called syndication. And if you've watched some of my previous videos, you may recognize this word. It's a fancy word. And all syndication means is that you have a bunch of different passive investors, and they all pool their money together. And then there's somebody called the general partners. And these are the people that are active. They have the experience, they have the track record, they have all the connections, they have the clout with the brokers, all that sort of stuff. They're the people going out, doing these deals, finding the deals, putting them under contract. They know how to manage the deals, and they know how best to get returns for investors, all of that. So the general partner will use these investor funds that are pooled to go out and acquire a property. And then the general partner will work to earn a return for those investors. So that's the word syndication. So you want to familiarize yourself with how syndications are structured. There's also something called a fund, which I've spoken about in previous videos, but right now we'll focus just on syndication. So how does this work with passive and active investors? Well, on the passive side, you'll be a limited partner, so LP. And a limited partner, it's limited risk. There's a whole bunch of protections afforded by the law to passive investors because they are not deemed to be experts. The experts are the general partners. And then on the active side, like I said, you have a GP. So you want to learn these terms. So when they come up in literature and when you're speaking with people, you don't have to be an expert. You don't have to be a syndication lawyer or expert, anything like that, but you just want to be familiar with the terms and know that a syndication is where all these investors pool their funds together to acquire a piece of property with the help of a general partner. And they're able to participate in these large deals that there is no way they would be able to participate in if they were just on their own. Let's say you are a full-time doctor, and I know doctors work crazy hours, very overworked. If you want to be an active investor, what sort of deal can you take down if you're already working crazy hours? Well, you can't really take down a deal, and would a broker, let's say there's a broker selling a 300-unit apartment building. And let's say there's 4 people offering on this property, which is usually the case these days. Why would that broker entertain a phone call from a doctor who's busy doing doctor stuff when there's 3 professional real estate investors who have the teams in place, they have the experience, they have the track record, they have the money, they probably have a previous connection with the broker, they've done deals in the area. The seller can check, they're willing to close, they usually do close unless there's a big problem. All of this stuff plays into it. So why would this doctor working his full-time job even get a call back from the listing broker for this 300-unit property? Well, I don't think they would. The broker and the seller, because the seller wants to close, the seller wants to make sure he or she gets their money. They'll be talking with the general partners, so the professional real estate investors. And this is how a passive investor can really piggyback on the success of a full-time real estate investor, the general partners, and participate in these amazing deals and get all these tax benefits. I've talked a lot about the tax benefits of real estate, and you have cost segregation, you have depreciation, and basically you can wipe out a large portion, if not all, of your earnings on your real estate investment deals through these really interesting structures and the tax code. So, the whiteboard got super messy. So as I erase what I've done so far, because I can't even make sense of this at this point, if you are interested, just hop on over to callseth.com and we can have a quick chat, and maybe without the whiteboard, because I tend to go a little overboard with my circles. I feel like I'm still doing like a hockey practice, and I'm drawing all the X's and O's. So after you familiarize yourself with the syndication structure, you want to start meeting syndicators. So meet with these professional real estate investors, the general partners that are doing these deals. So meet GPs. Because what's going to happen is each general partner is going to have their own based on their own experience and which type of asset they're working in. And within an asset, you have different classes. So for instance, with a multifamily asset, you'll have like your AA properties, which are premium downtown locations, brand new products. Then you have your A class, B, and C. Each syndicator, each general partner is going to have their own specialties, because a C property is in no way comparable to a AA property. It takes a different skill set. There's different factors that go into these properties. AA tenant, like these are very high class tenants. They're expecting the best of the best inside. But a C property, or even a C minus property, you have workforce housing. You're going to have some more issues with the tenant profile. So it takes totally different skill sets. So find out what the general partners, what their specialty is, what's their investment philosophy. Are they more conservative? Are they a little more aggressive? What's their personality like? Do you like the person? Because I don't feel you should be doing business with somebody unless you like them, because you're going to be talking quite a bit over the course of the deal, because some of these deals are held for 5, 6, 7 years. Some of these deals you're in and out in 2 or 3 years, but you have to like the person, understand where they're coming from. What's their track record like? What's their team like? Who are the other people working with them? Do they have strong relationships with property management in the area? How many other investors do they have working with them? Do they have trouble raising funds for their deals? Are their deals often oversubscribed on the first day? And what I mean by oversubscribed is, do those deals basically fill up with investment money on the first day, which happens? If these are very good full-time professional real estate investors, good GPs, you want to make sure you're on their list. So as soon as they get a deal, they're going to be calling you and saying, "Hey, Mr. and Mrs. Passive Investor, I have this deal coming up. Are you interested?" Because you don't want to be left behind and have the deal all full before you make your decision. So start meeting general partners, syndicators. If you go to, I would even encourage you to go to some real estate conferences and listen to the speakers. Even though you're on the passive side, I am a big proponent of passive investors being educated about the product. Now, nobody's saying you have to be an expert, but you want to be familiar with the strategies, the terms, who's who in the business, and that's just going to make you feel a lot more comfortable and allow you to make better real estate investing decisions. Now, a good general partner, a good syndicator, will answer all the questions up front that you have. They'll walk you through their particular investing strategy. They'll let you know what they're thinking for specific properties. They'll let you know, challenges they've had in the past, how they overcame those challenges. Most of these syndicators will have typical deals, so deals that they like. Some enjoy heavy lifts, some don't like heavy lifts. They just like lipstick renovations and operations, all that sort of stuff. So you just want to meet them and figure out what they're all about. And then after that, after you meet with them, you'll get on their list and you'll start getting phone calls when they have deals, and then you're going to start looking at deals. And this is the fun part, but also a very important part. So, and this is where the education component comes into things. I want you as a passive investor to be educated, to understand what an internal rate of return is. What's the difference between IRR and ROI? They're different, and maybe I'll do another video on that just to explain things a lot better. You want to know the different terms, what's the industry average, if there is an average, which I would say there's not, but what are typical terms? What's a preferred rate of return? All these different things you have to educate yourself on. So once you're looking at deals, so the general partner, once they have a deal under contract, they'll approach their accredited investor database and they'll say, hey, listen, Mr. and Mrs. Investors, I have this deal. Are you interested? This is our business plan on this. And you'll start looking at deals, and there's no pressure for you to invest, but if the deal looks good and it's within your parameters and you feel comfortable, not only with the people working on the deal, but with the business plan, the outlook of the area, all of that sort of stuff, you'll pull the trigger and you start wiring funds over. And I've covered that in previous videos, so I won't go into those details. But if you are interested in learning about the different market drivers, you can actually head on over to my website, sethferguson.org, and there is a report that outlines the 7 key market drivers I look at when analyzing a real estate market. And I should have put the link down below because I think this would be a really good thing for somebody looking at passively investing in real estate to read through, because they'll start getting familiar with the terms and the forces that act upon a piece of real estate in any given market. And I did mention accredited investors, so I will just briefly explain what a accredited investor means. Because lots of these deals, and like I said, if you follow me quite a bit, I've shared with you that the best real estate investment deals out there, the best ones, cannot be advertised to the general public. The reason is we have securities laws, and the Jobs Act has really opened things up a little bit. But you have to be an accredited investor to participate in some of these, and I would say most or almost all of the best real estate deals. So who is an accredited investor? Well, you want to be making $200,000 a year, or as a couple, $300,000 a year, or you can have $1 million of assets excluding your house. So no house or primary residence. If you have a couple other properties, you can include those in your assets. But accredited investors, $200,000 a year for the past 2 years with a reasonable expectation of doing the same this year, or $300,000 as a couple, or $1 million of assets excluding your primary residence. So if you do fit these criteria and you are interested in passively investing in real estate, learning more about the types of deals and the opportunities out there, just go over to callseth.com and we'll have a quick chat, and we'll see if passively investing in a real estate syndication structure is for you. And if not, I can suggest some other people you can speak with who invest in different structures. Maybe a single family home would be best for you. But the advantages of doing these large real estate deals, you get they're the most stable asset out there. You get all these tax benefits through cost segregation and depreciation. You get very strong cash flow, and plus these large deals are valued using the income approach, so you can make a big impact on the NOI and the value of the property by coming in with an experienced team and really turning the properties around. So, like I said, any questions, just pop on over to callseth.com. I hope this explained how you can start passively investing in real estate. So, number 1, you want to figure out if you want to be passive or active. Number 2, are you an accredited investor? That's important. Then you want to figure out the types of assets out there, so whether it's multifamily, mobile home parks, retail, industrial, office space, you name it. Then learn about the syndication structure, who's a GP, who's an LP, exactly what goes along with that. Then you want to start meeting with syndicators, general partners, learning what their own personal philosophies are, because everybody's different. Everybody has their own style. And then you want to start looking at some deals. So if you want to talk about real estate investing, call Seth.com, and I will talk to you then.